Discipline always comes before profits, not after, not alongside, before. Anyone who believes money is the starting point has already misunderstood the game. The market does not reward desire. It responds only to behavior repeated over time. Most people chase results. They want profits first, discipline later. They tell themselves they will become disciplined once they start winning. But winning without discipline is temporary. It creates confidence without foundation, and that confidence becomes the seed of the next mistake. Discipline is uncomfortable. It feels slow. It demands restraint when the mind is screaming for action. It asks you to wait when every part of you wants to jump in. That waiting feels like missing out. It feels like falling behind. Yet it is the waiting that separates survival from regret. There are moments when a trade looks perfect, feels perfect, and still does not meet the rules. Those are the moments that expose character. Taking that trade may feel harmless, even intelligent. But one exception weakens the entire structure. One small compromise trains the mind to negotiate again next time. The market remembers every compromise, even when you don't. Discipline means accepting boredom without creating excitement. It means watching price move without participation and feeling no need to interfere. It means closing a trade exactly where planned, even when the urge to stay feels overwhelming. It means taking a loss calmly, without justification, without anger, without revenge. Losses test discipline more than wins ever will. Winning can hide flaws. Losing reveals them instantly. When money is lost, emotions rush in with explanations, blame, and urgency. Discipline stands still in those moments. It does not argue. It does not react. It follows the process exactly as designed. Many abandon discipline during drawdowns. They believe rules stop working when conditions change. In truth, it is their patience that collapses. They begin adjusting, forcing, overtrading. They seek control in a place where control does not exist. Discipline accepts uncertainty without resistance. It does not need to know what will happen next. It only needs to know what to do if something happens. That clarity removes fear, not because fear disappears, but because fear no longer decides. Profits are a byproduct. They arrive quietly, without celebration, after long periods of restraint. They come from hundreds of small, correct decisions that felt insignificant at the time. No single trade creates consistency. Consistency creates every meaningful result. Those who focus on money feel every tick emotionally. Those who focus on discipline feel detached, almost indifferent. They understand the account balance is a reflection, not a goal. The goal is execution. There will be days when discipline feels pointless, when following rules produces nothing. When patience seems unrewarded, those are the most dangerous days because they tempt abandonment. Yet discipline is not proven in easy markets. It is proven when nothing works, when frustration builds, when silence replaces excitement, when sticking to rules feels heavier than breaking them. The market does not care how disciplined you were yesterday. It demands it again today and tomorrow, and every time money is placed at risk. Instinct feels powerful. It arrives quickly, confidently, and without effort. It convinces you that you see something others don't. In the market, that feeling is dangerous. Instinct is shaped by emotion, memory, recent wins, recent losses, and ego. It reacts to pressure. Rules exist to neutralize that reaction. Most traders trust their gut because it feels personal. Rules feel cold and mechanical, yet the market itself is cold and mechanical. It does not respond to belief or intuition. It responds to order flow, supply, demand, and time. Wants to act now. Rules force you to wait. Waiting feels like weakness to the undisciplined mind. There are moments when instinct screams that price is about to turn. The chart looks stretched. The move feels exhausted. Everyone else seems late. Acting on that feeling creates temporary satisfaction. It feels clever. But cleverness fades quickly when price continues without you. Rules do not care how convincing a setup looks. They care only about alignment. Alignment with trend. Alignment with risk. Alignment with structure. Anything outside that is noise. Instinct chases certainty. Rules accept probability. The market never offers certainty. It offers chances. Rules are built around managing those chances. Instinct tries to predict outcomes. Rules prepare for outcomes. That difference determines survival. After a winning streak, instinct grows louder. It tells you to increase size, loosen stops, take marginal setups. It whispers that you are in sync with the market. In reality, you are drifting away from discipline. Rules are designed to prevent that drift, especially when confidence is high. Confidence is often more dangerous than fear. Fear can cause hesitation. Confidence removes restraint. Rules act as a boundary in both states. They keep fear from freezing you and confidence from overexposing you. There are days when instinct urges you to trade just to feel involved. Silence feels uncomfortable. Watching others move feels like falling behind. Rules protect you from that need for participation. They remind you that doing nothing is also a position. A rule-based trader is not bored. He is selective. Instinct does not understand cost. It ignores risk in exchange for excitement. Rules calculate risk before reward is even considered. They define how much can be lost before anything is gained. That order matters. When instinct is followed, losses feel personal. When rules are followed, losses feel expected. One damages confidence, the other preserves it. Rules remove the need to be right. Instinct demands validation. That demand creates attachment to trades. Attachment delays exits. Delayed exits turn small mistakes into large ones. The hardest moment is when instinct and rules disagree. That moment arrives often. A setup almost fits. One condition is missing. Instinct urges flexibility. It argues that this time is different. Rules do not argue. They either allow action or deny it. That clarity is uncomfortable, but it prevents regret. Instinct thrives on exceptions. Rules collapse when exceptions become habits. Every trader remembers the one time instinct worked. Few remember the many times it didn't. Memory is selective. It highlights wins and softens losses. Rules are not influenced by memory. They are written to protect against it. Under stress, instinct becomes louder. Losses make it urgent. Wins make it arrogant. In both cases, it seeks control. Rules accept lack of control and operate within it. Following rules feels restrictive at first. It feels like giving up freedom. Over time, it becomes the only freedom that matters. Freedom from emotional swings, freedom from self-doubt, freedom from impulsive damage. Rules do not eliminate emotion. They limit its authority. There will be times when instinct feels painfully accurate, when price does exactly what you felt it would. Ignoring that feeling can be frustrating, but frustration is cheaper than regret. One is emotional discomfort. The other is financial damage. A rule-based trader measures success by execution, not outcome. A good trade can lose money. A bad trade, see, and make money. Only rules can tell the difference. Instinct judges immediately. Rules judge over time. Markets change character. Volatility expands and contracts. Trends accelerate and stall. Rules are not rigid predictions. They are adaptable frameworks. Instinct reacts to every change as a threat or opportunity. Rules respond only when conditions truly shift. The mind wants simplicity. Instinct offers it through certainty. Rules offer simplicity through process. One collapses under pressure. The other survives it. There is no pride in following rules, no excitement, no applause. That is why few commit fully. The reward is quiet. It shows up slowly. It shows up in stability, not thrill. Instinct wants to feel alive. Rules want you to stay alive. Every time rules are followed against instinct, discipline strengthens. Every time instinct overrides rules, weakness grows. The account reflects that balance eventually, without exception. Rules do not promise profits. They promise survival. Survival creates opportunity. Opportunity over time creates results. The market does not punish instinct immediately. It allows it to work just enough to build belief. Then it takes everything back with interest. Rules never feel brilliant. They feel repetitive, predictable, almost dull, yet they carry the weight of experience, failure, and restraint. Those who last learn to trust what they wrote when they were calm, not what they feel when they are exposed. Losses arrive quietly at first. Small, almost harmless, easy to explain away. That is why they are dangerous. Most traders do not fear losses. They fear being wrong. And in trying to avoid that feeling, they turn simple losses into personal battles. A loss is not an accusation. It is not proof of failure. It is feedback. It shows where expectations did not align with reality. Refusing to accept it does not change the out-see. It only delays the lesson and increases the cost. The market charges tuition. Everyone pays it. The difference is in how it is paid. Some pay in small, controlled amounts and learn quickly. Others refuse the lesson and pay everything at once. Small losses are the price of participation. There is a moment after a trade turns against you when acceptance is still easy. The stop is close. The damage is limited. That moment passes quickly. Hope steps in and offers comfort. It suggests waiting, adjusting, explaining. That comfort is expensive. Hope is not patience. It is denial wearing a calm face. When a loss is taken immediately, it stings briefly. When it is delayed, it infects confidence. It lingers in the mind long after the trade is closed. One clean loss preserves clarity. One messy loss creates hesitation for the next opportunity. Losses teach humility faster than wins ever will. Winning reinforces belief. Losing forces examination. It exposes emotional weaknesses that profits hide. It reveals whether discipline is real or only present during comfort. There is no shame in losing money according to plan. The shame comes from breaking rules and pretending the market was at fault. Responsibility is heavy, but it is also freeing. When losses are owned, they stop controlling behavior. Many traders chase recovery after a loss. They rush into the next trade with urgency. That urgency is not confidence. It is fear of falling behind. It replaces logic with desperation. One loss does not need to be recovered. It needs to be accepted. Losses are data. They show which conditions are unfavorable. They highlight market phases to avoid. Ignoring them wastes information that was paid for. Over time, losses build emotional strength. They train detachment. They remove attachment to being right. They remind you that uncertainty is permanent. The trader who cannot lose. Cannot stay. Losses will never disappear. They will only change shape. Early on, they feel devastating. Later, they feel routine. That transition marks growth. Not because losses hurt less financially, but because they no longer shake identity. Every professional accepts losses as part of the process, not reluctantly, fully. A trader who respects losses respects risk. A trader who respects risk survives. Survival creates time. Time creates opportunity. Opportunity creates consistency. Losses are not enemies. They are teachers that speak through numbers, not words. The market never explains. It only charges. The lesson is taken or repeated. Those who learn early pay less. Those who resist pay everything. Patience feels passive to the untrained mind. It looks like inaction, like hesitation, like fear disguised as discipline. Yet patience is not the absence of effort. It is effort directed inward, restraining impulse while the world moves without you. The market is always moving. That movement creates pressure. It makes you feel late. It makes you feel excluded. Watching price run without you triggers urgency. The urge to participate grows stronger with every candle. Patience stands against that pressure and absorbs it quietly. Most mistakes are made not because a trader didn't know what to do, but because he acted too soon. Opportunity does not announce itself loudly. It does not beg for attention. It forms slowly, often boringly, while the impatient look elsewhere. Patience is the ability to stay present without forcing meaning onto every movement. There are long stretches when nothing aligns. No clean structure, no favorable risk, no clarity. Those periods feel unproductive. They make you question your edge. They tempt you to lower standards just to feel involved. Lowering standards is the most expensive shortcut in trading. Patience means allowing the market to prove itself before committing. It means waiting for confirmation, not imagination. The mind loves anticipation. It wants to be early. Patience is willing to be late if it means being right. Being early feels smart. Being patient feels dull. The market rewards dullness. Impatience creates false urgency. It convinces you that this moment is rare, that hesitation equals loss. In reality, opportunities repeat endlessly for those who are still present to see them. The market does not run out of chances. Traders run out of patience. Waiting tests ego. It forces you to watch without control. It removes the illusion that you can influence outcome through effort alone. That loss of control is uncomfortable. Many would rather lose money than sit with that discomfort. Patience accepts that not every move is meant to be traded. Some movements exist only to trap the impatient. They look clean, feel urgent, and collapse quickly. The patient observe these without emotion. They let others pay for information. Time filters noise. Patience lets that filter work. Every experienced trader learns that the best trades feel obvious only in hindsight. In the moment, they often feel slow to develop. They require waiting through uncertainty. They demand trust in preparation. Patience is trusting the work done before the market opens. When patience is absent, execution becomes reactive. Trades are entered late, exits are rushed, size is adjusted emotionally. When patience is present, execution feels calm, almost detached. Calm execution comes from delayed gratification. There is a difference between patience and indecision. Indecision comes from fear. Patience comes from clarity. One avoids action because of uncertainty. The other avoids action because conditions are not met. That distinction matters. Patience does not hesitate when rules align. It acts immediately and without doubt. It waits only when waiting is required. Many confuse activity with progress. Screens are watched endlessly. Indicators are adjusted. Notes are rewritten. All of it creates the illusion of work. Patience does less and achieves more. The market rewards selectivity. Opportunities are strongest when few are paying attention. They form after boredom, after frustration, after long periods of inactivity. Impatient traders leave during these phases. Patient traders remain. Remaining is a skill. Patience also applies after entry. The urge to interfere does not disappear once a position is taken. Watching unrealized profit fluctuate tests resolve. Small pullbacks feel threatening. Small gains feel fragile. Impatience takes profit too early out of fear. Patience allows space for development. Letting a trade breathe is harder than entering it. There is a temptation to protect unrealized gains at the first sign of discomfort. That protection often suffocates potential. Patience understands that volatility is not danger by itself. The market does not move in straight lines. Expecting it to do so is impatience disguised as logic. Patience holds through normal fluctuations without emotional reaction. It knows the difference between noise and failure. That knowledge comes only from experience and restraint. Impatience seeks certainty. Patience accepts probability. After losses, patience becomes even more difficult. The desire to recover creates urgency. Urgency destroys selectivity. Trades are forced. Standards erode. Patience after loss is an act of discipline. Sitting out after a loss feels like surrender. In truth, it is control. It prevents emotional carryover. It allows clarity to return. The best opportunities often appear after long waiting, not after frantic searching. Patience also protects from overconfidence. After wins, excitement builds. The mind wants repetition. It assumes rhythm where randomness still exists. Patience slows that momentum and restores balance. Balance keeps size appropriate. It keeps risk stable. The market does not respond to desire. It responds to timing. Timing cannot be forced. Patience is alignment with time. It is the willingness to let conditions mature, to let patterns complete, to let others reveal their intent before committing capital. Those who rush into positions become liquidity for those who waited. Patience feels lonely. It separates you from the crowd. While others are active, emotional, vocal, you remain still. That stillness is misunderstood as hesitation. Stillness is strength. Over time, patience reshapes perception. You stop seeing missed trades as losses. You stop feeling urgency during movement. You stop measuring success by frequency. Success becomes measured by quality. Quality requires time. The market teaches patience brutally. It rewards it inconsistently at first, testing belief. Then, quietly, it begins to favor those who waited. Opportunities appear clearer. Decisions feel simpler. Emotional swings soften. Patience does not guarantee profits. It guarantees readiness. Readiness allows opportunity to be recognized when it finally arrives, and it always arrives after the impatient have already spent themselves. Emotion is subtle. It doesn't always arrive as panic or excitement. Sometimes it shows up as confidence, sometimes as logic wrapped in urgency. It convinces you that this decision is rational, that this time is different, that hesitation will cost more than action. The market exposes emotion not through chaos but through repetition. Fear appears when price moves against you faster than expected. The heart tightens. The mind starts bargaining. Stops feel too close. Losses feel personal. Fear doesn't ask for permission. It reacts. And reaction is expensive. Greed is quieter. It feels like optimism. It whispers that more is possible, that the move isn't finished, that size can be increased safely. Greed doesn't feel reckless. It feels deserved. That makes it harder to detect. Hope is the most dangerous emotion of all. Hope delays decisions. It turns exits into negotiations. It replaces responsibility with waiting. A trade that should have ended cleanly lingers, draining focus and confidence. Hope keeps capital trapped in bad ideas. Pride enters after success. Wins create attachment to identity. You begin to associate results with intelligence. Losses then feel like threats to that identity. Pride resists correction. It avoids stops. It seeks justification instead of adjustment. Emotion narrows perception. It reduces the field of view. You stop seeing structure and start seeing only what supports the current position. Contradictory information is ignored. Confirmation becomes comfort. Emotion speeds everything up. Decisions are rushed. Entries are late. Exits are reactive. The calm rhythm of execution disappears. The market punishes speed without preparation. Rules exist to slow emotion down. They create space between impulse and action. In that space, clarity lives. Without rules, emotion moves unchecked, making every decision feel urgent and personal. Many believe they can manage emotion through awareness. Awareness helps, but it does not stop reaction. Only structure does. Only predefined limits remove emotion's authority. Emotion does not disappear with experience. It becomes more convincing. The more time spent in the market, the more confidence emotion gains. It learns patterns. It borrows language from discipline. It tells you this feeling is experience speaking. That is how emotion defeats intelligence. Emotion also thrives in isolation. When decisions are internal and unspoken, emotion grows unchecked. Rules externalize decisions. They create accountability to process, not feeling. Every emotional decision leaves a mark. It may not show immediately. Sometimes emotion is rewarded. That reward is a trap. It reinforces behavior that will eventually fail under different conditions. The market teaches slowly, then all at once. Emotional traders live in cycles of excitement and regret. Calm periods followed by impulsive damage. Repair phases followed by renewed confidence. The cycle repeats until capital or belief is exhausted. Discipline breaks the cycle. The enemy is not the market. It is not volatility. It is not complexity. It is the human tendency to feel before thinking. Emotion wants comfort. The market offers none. Those who learn to operate without emotional attachment gain an edge that cannot be copied. Not because they feel less, but because feeling no longer decides. Control is not suppression. It is delegation. When emotion is removed from authority, decisions become simple. Not easy, but simple. The market does not reward emotional intelligence. It rewards emotional obedience. Those who understand this stop fighting themselves and start following structure. And structure outlasts every feeling. Survival is rarely glamorous. It does not come from bold predictions or dramatic wins. It comes from restraint, from knowing how much can be lost and refusing to exceed it. In the market, survival is the first achievement. Everything else is secondary. Many focus on success without understanding its cost. They imagine growth without drawdown, confidence without damage, rewards without risk. The market removes those illusions quickly. It demands respect before offering opportunity. Risk is not an abstract concept. It is real money, real time, real emotional energy. Every trade risks not just capital, but clarity. Survival protects both. A trader who survives bad periods is already ahead of most. Survival requires humility. It means accepting that the next trade could fail, that the analysis could be wrong, that the market owes nothing in return. Arrogance increases exposure. Humility limits it. Limiting risk feels restrictive to those chasing rapid growth. It feels slow. It feels cautious. Yet caution is what keeps you in the game when conditions turn hostile. The market changes character without warning. What worked yesterday can fail today. Volatility shifts, liquidity disappears, trends reverse violently. Survival depends on flexibility within structure, not stubborn commitment to ideas. Position size determines survival more than entry accuracy. A mediocre entry with proper size can survive. A perfect entry with excessive size cannot. Size is emotional leverage. The larger the size, the louder the emotion. Survival keeps size small enough that decisions remain rational. When fear dominates, logic disappears. There are periods when the best decision is to reduce exposure or step aside completely. That choice feels like retreat. In reality, it is preservation. Preservation creates optionality. Capital preserved is capital ready. Capital lost removes choice. Without choice, discipline collapses. Survival also means knowing when not to trade. Fatigue dulls judgment. Frustration narrows perception. Excitement creates carelessness. Survival respects mental limits as much as financial ones. The market will always be there tomorrow. Survival understands time as an advantage. There is no deadline to succeed. Pressure is self-created. Removing pressure restores clarity. Those who rush burn out. Those who endure adapt. Survival requires accepting slow progress. Compounding is quiet. It does not feel impressive day to day. It builds beneath the surface while impatience seeks visible progress. Short-term wins feel powerful. Long-term survival feels ordinary. Yet ordinary is rare. Most accounts are destroyed not by one catastrophic decision, but by a series of small avoidable risks. Slightly larger size, slightly wider stops, slightly more frequent trades. Each decision feels justified. Together they accumulate into failure. Survival demands saying no repeatedly. No to marginal setups. No to emotional recovery trades. No to overconfidence after wins. No to boredom-driven activity. Saying no is strength. The market respects those who respect themselves. That respect is shown through boundaries, clear limits, defined risk, consistent behavior. Survival does not eliminate losses. It ensures they remain manageable. It ensures that no single mistake can erase years of effort. Those who survive long enough begin to see opportunities others cannot. Not because they are smarter, but because they are still present. Presence is power. Survival creates perspective. Losses no longer feel catastrophic. Wins no longer feel intoxicating. Balance replaces extremes. In that balance, consistency becomes possible, and consistency is where real progress lives.